Hey everyone, this month I am partnering with Questrade and they've got a special offer for In the Money listeners. Questrade is focused on building the future of investing right here in Canada, and they've rolled out some real game changers. We're talking about the new trading platform, Questrade Pro, which is in beta right now for select users. If you want to join the beta group, you can sign up on their waitlist. Now, when it's fully released, you will be able to trade directly from best-in-class charts. You'll have lightning-fast execution. You'll have AI tools, a full trader performance dashboard, and the best part, it's totally free to access. Now, in the first quarter of 2026, you're going to be able to trade assets like real physical gold right inside your Quest Metals account, just like a stock. And then they're first in Canada to make cash-secured puts available in all of your registered trading accounts, except for an RESP. That's a huge, sophisticated income-generating tool now available to everyday Canadian investors. But the one that really floored me was their 2026 announcement for custom indexing. You can take the S&P 500, dial down the weighting in one sector, dial it up in another, and buy those stocks directly. Why would you pay an ETF fee when you can essentially build your own customizable index for free? Use my special promo code INTHEMONEY, all one word, when you sign up for your first self-directed account, and you'll get $50 as a cash reward. Or you can open up a Quest Wealth Portfolios account and you'll get your first $10,000 managed for free for 1 year. Go to questrade.com. Remember, promo code INTHEMONEY. You guys want a cookie? It's just like our phone calls every single day. Are you sick of me after a year?
No, but this is not. Is my nose glistening?
The moment it glistens, please cut the broadcast. It's where you put me. In marriage and in the money. It is always the one man's fault. It looks amazing.
This feels too low, Georgine.
Okay. Do I look okay?
You look great.
Not that
This is not about you today.
Look alive. Hello, everyone. Welcome to a very special holiday edition of In the Money with Amber Kanwar. Against her will, as always, I'm making producer Jillian sit with me. Hello, Jillian.
Hi. How are you?
Happy holidays.
Thank you. You too.
I am forcing you to be festive because we've got an amazing show. We've had this incredible year, and what we want to do with you is recap it. So sit down, get cozy. We're in our cozies.
Grab a mimosa.
Grab a mimosa. Cheers.
Cheers.
To our first year at In the Money. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones. Whether that's buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you'll benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $88 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Okay, so in this episode, we are going to do a few things. We're going to recap highlights of the show. We're going to go through performance. At the end of the day, what's our show about? Get ideas, make money. So we're going to go through standout performance. we are going to name the best performing fund manager in terms of their pro picks. Because if you're not familiar with the show or new to the show, every episode when we interview a fund manager, we get their 3 top ideas. We've been tracking them all year. And I know it's not a perfect way of doing it, but it's a fun way of doing it for the purposes of this show. But before we get into all of that, I just want to reflect on this incredible year that we've had. A year ago today, Jillian and I didn't know how to do a podcast.
It's true. Yeah.
And it kind of started with me Googling how to do a podcast like a year ago. And what were you doing?
Well, I think I'll say, even though I had never produced a podcast before, like the skill set is kind of the same as producing a TV show or something like that, like a BNN or CNBC show, but just the medium is different. So I knew we could do it. Like that was not the issue. I for sure knew we could do it, but we just sort of had to learn how to do it in this way, basically.
And we didn't have camera crews. We didn't have editing. Yeah. You and I don't know and still don't know how to turn these cameras on. So shout out to Georgina Million, who make all of this happen. We're a nice family of 4. And people don't know this, but how you and I came together. We've been working together for, how long did we work together at BNN? Maybe like 5-6 years.
Yeah, something like that, yeah.
And then you left and you went to Greater Pastures, CNBC Singapore, CNBC London, and then you came home. And of course, we're friends.
Yeah, we always stayed friends.
Yeah. But we weren't in regular touch. Like, I didn't know what was going on in your life, and you didn't know what was going on in mine from a professional perspective. And I got a call from you saying, I think I'm going to be looking for something new. And I kid you not, I said to Jillian, tomorrow is my last day at BNN. And she had no idea.
Yeah.
And I don't know if I even asked you or if you asked me, but I was like, I'm going to do a podcast.
Yeah. I don't think either of us asked each other. We just kind of knew, okay, we're going to do this podcast together, basically. It just happened. There was no conversation about it.
No, it just happened. So, and we're still friends. Mm-hmm. We've managed.
Yep. Still friends.
Which is hard to do, by the way.
Yep. Mm-hmm. A year in.
Year in. There've been some stiff conversations.
I wouldn't. Do you think so? Not even.
Yeah. Okay. So we're all pals. We all love each other. Kumbaya, right? Georgina and Million. They agree. They're forced nodding. Okay, so let's go through some highlights from our first year. I think we have to talk about, so in 2 months, we launched our first episode. Yeah. From knowing nothing, from having no business, we launched our first episode. Yeah. We do our first episode with Eric Jackson, all kinds of issues. Our cameras died. The room is hot. And do you want to describe the most stressful point of that?
So our very first episode, we finish. It's in the can, as they say. And we lost the card that holds the audio.
The guest is gone.
It's over. And we could not find the memory card that holds the audio. And this is a podcast, so it's kind of important.
Georgina, our editor, is the star of this show. She did drop it, but we were all trying so hard not to panic.
Yeah.
But whispering to ourselves, what the hell?
We were on the floor. We were crawling on the floor, looking for the card. And you know what? We found it. But that was definitely a panic moment for sure.
And then, so we do that episode. We do a couple more episodes. And again, I didn't know, are 5 people going to listen? Are, 45 people going to listen? I just had no idea. Neither did you. We'd done almost no marketing. I hadn't paid for any kind of marketing at that moment. And I think it was wild in that first month because you and I were still trying to figure out the production of it. You were up very late every night. We have 24-hour turnaround.
Yeah.
Up late every night, getting these episodes up.
1 a.m. Yeah.
And we've never missed. I want everyone to know it's not easy. We've put out episodes every Tuesday and Thursday at 6 a.m. And I promise you it has not been easy, especially in those early days.
Yeah.
But kind of in the first month, we knew it was a hit.
Yeah, I think we debuted at number 2 on Apple's charts. And I think when that happened, we were like, whoa. So we felt pretty good about that. And obviously, we've had ups and downs throughout the time, but I think that really helped set the stage for us.
I think for me, it was okay, we had these instincts. You and I had these instincts. What do people really want? They want access to these incredible ideas. And of course, they all want to make money. You and I want to make money. We want to be in the money.
Yeah.
And for a while, my husband was joking that this show was called Out of the Money. And hopefully we'll fix that in due course. And then we had some nice highlights as a show. We did our first road show. So like, we know nothing about podcasting. We do a podcast. It's very successful. Then a couple months in, we decide we're going to take all of this on the road, and we do our first live show at the Calgary Stampede.
Mm-hmm. It was big. Special shout out to our partners at ATB Financial, because they really helped us out there. It was with them basically. And they provided us like with a crew and a really, really great team.
And it was happening at a time where there was an incredible story taking place. Strathcona was in hot pursuit of its acquisition of Meg Energy, which ultimately it didn't get. But that was also my first time interviewing Adam Waterous, the chair of the Waterous Energy Fund, and of course of Strathcona. And he broke news on the podcast. It was the first time that he said, we're going to do this. If we don't get Meg, we're going to do $10 per share special dividend. And it's funny because at the time, I don't think I registered. I didn't know about that, but it was one of those moments as a journalist where you're like, well, would he have just said that? Like maybe I missed it in my research. But then after the fact, we realized, oh no, that was brand new information. I had people reaching out to me saying the same thing. Has he said that before?
Yeah.
It was great to be the platform where that kind of was revealed first, and other news outlets picking it up.
Yeah, that was big for us, definitely. And we moved the stock.
It's a thin float. So
the stock moved. But I actually also remember like one of our friends in Calgary who sort of, plugged in there, letting us know like the interview was the talk of the town. So that was, I think, important as well.
Has Meg engaged with you?
We've never had a conversation with the board. They've never reached out to us. We've reached out to their financial advisor to say, we'd love to get involved in the process, but they have declined. Now, if we don't buy Meg, we'll probably, issue a dividend of maybe about $10 a share. At that point, we'll be about 1 times debt to EBITDA, still very lightly levered.
Like a special dividend.
A special dividend. And continue on. So we think that's a really good plan A. And we just think Meg's plan A plus.
And it was the first time that we did anything with a live audience. And it was amazing to see all these people who have supported the podcast actually in real life. So we got to meet a bunch of In the Money fans. It was a fun, wild experience.
Yeah. And we had another big, fun, wild experience recently, actually, where you had the opportunity to interview Prime Minister Mark Carney.
That was wild for a bunch of reasons. I guess I should tell this story. I'll tell it on the podcast. But so Mark Carney lays out the budget, because this is behind the scenes. We'll talk about the interview as well. But Mark Carney and the government, they put out their federal budget. And from what I gather is he wants to communicate it to a business audience. And so the Canadian Club is tasked with hastily putting together an event, which they did an incredible job of doing. Meanwhile, while this is going on, unbeknownst to me, I'm on a family trip to Disney, which I know people are saying boycott US, like put that aside for this story. I have 3 young kids, like I have to do something with them. Okay, so we go, so we're going to Disney. It's a Wednesday. And we've landed and we've, survived the flight with 3 children. All the iPads worked. And we're driving to the hotel. And I just happened to check my email, and I have a request in my inbox from the Canadian Club asking if I will interview the Prime Minister on Friday. I am supposed to stay at Disney until Sunday. And so I just kind of say out loud, oh man, shoot, I'm missing this. And at no point did I ever think that it was possible. It was just like, I'm in mom mode and that's it. This is just one of those things that happen. And I literally thought to myself, I'm like, hopefully I'll get another shot. And because I said this out loud, my mom and my husband were in the car, and my husband was like, absolutely not. And my mom. But my husband kind of had more to lose because he would have had to really deal with the kids at Disney. But he said, absolutely not. Go home. You need to go home. And he mapped out the logistics of how I would do that. So Thursday, I did Magic Kingdom all day with the kids. Then I flew home Thursday night. Friday, I did the event with Mark Carney. And then right after that, I flew back. So I really only missed one day with the kids, which felt like sort of a victory.
Yeah, definitely. And I mean, shout out to Stefan for being such a supportive husband.
Yes, that day and all the days. But also because Carney was kind of in rare form in that interview, it was getting a lot of play over the weekends on all the channels, CP24, CBC, CTV, all those places getting picked up. So my notifications are kind of blowing it up. And I'm just like, I'm in Orlando. It's like, why, the children dealing with like heat stroke or whatever it is. And it just felt like, wow, these are two, you don't know, like, what a lot of parents are dealing with. Like that was quite a balancing act for me. And my husband was like, please just put your phone away. You can't deal with these notifications right now. But the interview was also great because, he got heat for what he said about pipelines. Basically, he was kind of, again, I say he was in fine form, but he basically called it a boring topic. One of my questions was, is this pipeline going to come?
It's so boring.
It's not actually.
It is. It is because don't worry. We're on it. We're on it. Danielle's on line one. Don't worry. It's going to happen. But, something's going to happen. Let's put it that way. It's not very good negotiating by my perspective. But what some in the room will unlock on the data center side, the intelligence infrastructure side, will have a much bigger impact on productivity in this country. Will have a much bigger impact on our standard of living.
But if you listen closely to what he was saying, he was basically saying, it's done. Let's move on. I want to talk about something else. And it was a Toronto audience. And then guess what happened? A few weeks later, they strike a deal with Alberta to greenlight that kind of infrastructure. So that was kind of a cool moment.
Yeah, definitely. He basically told us, just people weren't listening, I think is what your point is. And so, we were the first to have it, basically, I would say.
That's right. And that was such a moment because, when I left BNN and when you leave CNBC and BNN, you think like, who am I? What am I without this infrastructure? And I think it just speaks to how the media landscape is changing as well. Like the fact that, independent media producers can have that seat and a credible seat at the table. We didn't know that, right?
Yeah, definitely when we started. Yeah, for sure.
None of this would be possible, honestly, without our sponsors. Like you should know that the people who have been with us since the beginning, we had nothing. We didn't have you as an audience, and they kind of took a bet on us, especially the folks at ATB. So special thank you to Lori, Crystal, and Kate. And Raymond James, Sam, Sai, and Alex also have been with us. And we've had so many people kind of poke their head into the show as well to help support it, from BMO, CI, Scotia, the Women's Initiative, which is on right now. And then fund managers while we were doing our CEO series, Middlefield, Murray Wealth. We've got Questrade now. So it's just been really
Hamilton
nice.
Too.
Hamilton, of course, yes. It's been really nice to have that support. And we couldn't keep the lights on without it. So thanks for doing that. Are you ready to talk stocks?
Yeah, definitely.
Thank you to our partners at ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information.
All right, it's time to talk stocks.
Let's do it. So what we did is we took everybody's pro picks, so not every stock that they've ever talked about, through the mailbag, but we took their pro picks. I tallied them all up, and the average return of all the guests is 21% from the middle of January. And that does beat the S&P 500 over that time. It doesn't beat the TSX. It hasn't beat the NASDAQ. I kind of wish, for the purposes of this show, that it was like way higher. But, we did have some really exceptional winners. And I want to be honest and not promotional. So when you take it all together, it's you basically met the market.
I think you're being a bit hard on yourself. Like 21% is pretty good.
Oh, yes, it's good. But it's like a raging bull market.
Sure. Okay.
So yeah, at least it didn't significantly underperform. But I'm excited to dive into what the themes were. And of course, in this segment, we're going to reveal the best performing fund managers.
I think we're going to start though with the most popular stock. Is that right?
I wonder if I can just give people a moment to guess. Like if you've been watching the show, the number one stock, what stock comes up in the Canadian energy sector? It is Tourmaline.
Tourmaline. We both bought it, I think.
We did buy. Finally, it took
Yeah.
some convincing. I don't think I bought it till like maybe the third guess.
Yeah, me too.
I was like, okay, there's obviously something here. It hasn't been an amazing performer still. And again, like if you're generally a proponent of long-term investing, like we're benchmarking off of a couple of months here. But it just speaks to the fact that people love Tourmaline. They love Mike Rose in particular. And right now the stock is kind of in the penalty box, even though there are fans of the business. And we spoke with Mike Rose. He was one of our CEO interviews when we came back in the fall. And he was really candid about, we're going to invest in future growth because that is the right thing for the business. And right now, the market is sort of punishing them because what they really like from Tourmaline is they love their special dividends.
That divvy.
And their buybacks. And so they prefer the capital that way. Natural gas had been a problem. The prices weren't really cooperating, though that's getting better. And other stocks that were a little bit more beaten up, like Peyto, have really outperformed. But all these guests plus Mike Rose basically are saying like it's coming, especially with the AI and the demand that is coming from there. Like natural gas has to be part of that. So their thesis is let's invest now, let's have all the assets, and then we'll be there when demand surges.
Mm-hmm. Tourmaline, without a doubt, preeminent leader within the Canadian natural gas landscape.
Bought Saguaro, bought Todd, bought Strathcona's piece, bought the other part of Saguaro. You look at a land map now and you're just like, well, they dominate Northeast BC.
If you're going to buy Tourmaline, put it in a drawer and forget about it for 6 years.
Consider it to be an investment in a collection of assets and a corporate culture that guarantees superior performance relative to most of its peers.
The electrification and the demand that you're seeing from AI and these data center buildouts.
He has 75 years of resource, and everyone still goes, what's his free cash flow yield?
A hedge fund might not buy it because you might not get that 1 quarter performance, but they are building something here that should generate 10% total returns for a long time.
Let's put it on your Christmas list.
Yeah.
I want Tourmaline for Christmas. I guess you have to decide if that's the right thesis. I decided, okay, let's test it out.
Me too. I think it's that thing of like, if so many people say it, like part of it has to be true. That's how I feel about it.
That's how we got into CNQ as well.
That's true.
It's not on the list as like the most loved, but people who love it really love it.
Yeah, it's up now though, slightly, just slightly. But I also feel confident about CNQ. I'm holding that one.
The CEO interviews were an experiment for us. The fund managers are easy, like in the sense of we know there's a market. We know everybody wants to hear about stocks that could go up or stocks that are at risk and really hear stress tests around those theses. The CEO interviews, it can be trickier because you need a CEO who will come on and be candid about the business and tell you in a maybe non-promotional way. Of course, they're going to be promotional, but in a realistic way, like what they're optimistic about. And then the goal is for the investor to decide, is this actually going to happen? Do I buy what the CEO is saying? And I think the best example of that in a way that it worked was when Ross Beaty came on.
Oh yeah, definitely. Yeah, that was such a big one because he came on during our summer series and, the stock had not been doing well for a while. And that's at a time when, other gold miners are just soaring basically. And he came on and he basically told us it's time. It's time.
First he acknowledged the mistakes.
Sure, yes.
And I think that speaks to a lot of credibility. He said, we messed up here, we messed up there, we messed up all this. This was the worst thing. Like, I am not happy with this.
Yes.
Right? So he comes on, he really owns
he was
it.
very candid. Mm-hmm. And he said, but now is the time. We're turning it around.
Literally the next week. Maybe even days later, the earnings come out. And it is time.
Yeah.
Like all the things that he was talking about finally being in place were showing up. Not in a specific way. He didn't violate any securities law, but basically he was saying like, this is how we've been working to get our act together. And I think we have gotten our act together operationally. The high level reason it had underperformed is there were a lot of operational missteps that meant it wasn't capturing the momentum in gold prices.
Equinox Gold was built as a custom creative vehicle to give investors superior leverage to the price of gold. In other words, leverage that they get with an equity rather than buying the metal. And yes, we had that wonderful run. We delivered that for the first 3 years. And for the last 4 years, we have underperformed and have not delivered that. But at the end of the day, what have we built? We've built a very large gold producing company, lower cost. Greenstone and Valentine will significantly lower our costs. We're actually going to be a giant cash generator in the next year, 2-3 years. $1 billion plus in operating cash flow. We'll have very, very little debt coming out of the next 2 years. And that's a great recipe for outperformance, I think. Getting to where, IAMGOLD was on the bottom, and then it finally sold a bunch of assets, got their big mine going, and now it's outperformed. We are just on the cusp of that. We call it an inflection point now. But at the end of the day, the company that I've been trying to build here with Equinox is I've wanted to build a big operating gold company. I'm convinced that scale matters. The bigger you get, the better multiples you get, the more diversification you get, the less risk you have, the better balance sheet you have. You can kick out a dividend. We're on the cusp of doing that now. Could be any quarter because, of course, now we're generating some massive cash flows. So we've got all these optionality opportunities, selling some assets, getting Los Filos going again. We've got exploration value coming all over the portfolio. It's a good story, and it's getting to be the one that I was sort of that I had envisaged when we began the company in 2018.
Okay, so I'm just going to look it up, actually. So the episode aired August 12th, and since then, Equinox has doubled, while the TSX is only up 13%, and the materials sector is only up 36%. So it went from being a huge laggard to a huge leader, and he really told us that was going to happen. So doesn't always happen with CEO interviews, but that was, kind of a shining example of like when it does pay to listen.
Okay, so let's talk individual stocks and fund managers.
I feel like this segment could piss off a lot of people because it's, different styles matter, timeline matters. This is an imperfect way to track performance. I want everyone to know that I know that the fund manager may have sold their stock, their return might be different because they owned it at different points, and it's not their entire portfolio. But I did the rankings and I tracked everyone's performance this is important, as of December 4th, 2025. So when they were on to December 4th, so this is going to miss a lot of the December movements, maybe not by much, but everybody should know that. If you do want to see this, we're going to post it on our website and I will email it out. So if you're not on our distribution list, go to our website, inthemoneypod.com, and you can subscribe to our newsletter and you'll make sure that you get it. Maybe we should talk first about the worst performing stocks. This is not an overly promotional show, but we did have some lemons.
Yeah, it happens. Definitely happens. A lot of drama at this worst performer, Dye & Durham.
Yeah, so Dave Barr picked this of the Pender Fund, and he has a long history with the company. And it certainly was not a pound the table buy. He was like, I'm going to put this in my pro picks, because he just looked at the value of the company. And I think at the time he said this should be a $25 stock. So right now, early December, it's trading under $3 per share. So like big delta, big potential upside. But yeah, fine. The core business, its legal software, is struggling, but the drama around it has been around the former founder of the company. So first of all, there's a family behind it, two brothers. They had a falling out. So the brothers are fighting, both out of the business. Then one of the brothers is coming in to try and buy the company, and the current board says no. And then I'm trying to remember all the details. Then the chair leaves, who was an activist investor responsible for kind of getting the brothers out. Like, that's gone. And then Matthew Proud, the main brother who'd been was the former CEO, puts in a bid. Then I'm pretty sure he takes out the bid, and then he puts the bid back in.
Yeah, drama. Exactly,
it's a lot
drama.
of hokey-pokey. And now he's suing the company. So I tried to reach out to Dave to see if he still holds it, but I wasn't able to get in touch with him in time. But again, he kind of knew this is like a risky bet. And to offset that, he also picked Kraken Robotics. which is up 146% since he chose it. And go back, listen to that episode. This is what small caps are, right? It's high risk, high potential reward, but yeah, you could lose 70%.
Yeah, I mean, I actually hadn't really followed that whole story. So just listening to you explain it now, like that was some good intel.
The second one, a larger cap, a little bit less drama, but underperforming, is a company called FISV. And this is basically like a payments company, payment platform, and facilitates financial transactions. Like if you're tapping your credit card, for example, FISV could be that company on the back end.
So that one was picked by Mike McCloskey of Greenskeeper.
And he's a value manager who likes compounders, is happy to stay away from like money losing tech and all that stuff. And truthfully, in 2025, money losing tech, fast money momentum, that was kind of the play. So Greenskeeper, as the name suggests, are in it for the long term. But I asked Mike, and I did get in touch with him about FISV. And again, I love it when a PM is candid. He said, this was a terrible pick, a compounder until it wasn't. But he still continues to own it. There's been a lot of tumult at the company. Basically, and I'll read a little bit from the email that Mike sent me. He basically said, we view the company differently after what the new CEO said on the third quarter call. He said, it looks like former management and the CFO, who was probably pushed out, did things to meet quarterly numbers that were bad for the business. And he says the new CEO seems to be doing the right things for the long-term health of the business and the customer. The lower growth rate materially lowered their valuation of the company. At the current price, you're getting double-digit free cash flow yield, which is too cheap. We continue to own it, but there is a price where we will probably exit the stock, and we're watching management very closely. So definitely in his mind, he's calling it and he's just saying like, not great. I'm willing to stick it out a little bit, not cutting his loss here, but also not pounding the table again and saying, I want to go back in.
Sure. Okay. And that makes sense. Great that he was so candid. I just want to also give a shout out to Mike, because he was very cool with us, because I had to reschedule him, I think 3 times, and he was super cool about it. And so thank you to Mike for that one.
He's a nice guy. We should talk about commodities in general. And I promise we're building up to the best fund managers of 2025. Shockingly, it's not a lot of commodity investors. There is a theme in those fund managers, but commodity episodes do the best for us. And that's probably because we've got this Canadian audience.
Yes, we know Canadians love their commodities. That's been made more clear to us this year for sure, based on our ratings and our views. But as you mentioned, our commodity guests have not been our top performers this year.
They've done well, though. Like Bob Thompson is a great example. That episode did really well. And he was talking about how we are in a cycle, in a long-term cycle for gold, for commodities in general. And the way he expressed that was through various ETFs. And again, go on our website and it's all there, what his picks were. And you can sort actually by guest too and rewatch. But on average, he's up about 43% just by picking those ETFs. And those were just in July. So that's a nice move and kind of broad-based gains. Another strong performer, and actually it came through via one stock, was Josh Young's pick of Journey Energy. Do you remember that?
Kind of.
He's like
oh no, I remember Josh for sure.
Yeah. Do you remember what he's about?
I know it's oil and gas.
Yes.
But I can't.
One of those, we've got some US fund managers that are super interested in Canadian energy.
Yeah,
Cole Smead is obviously one, and we'll talk about him in a second. But Josh was another, based in Houston, loving his Canadian energy. And one of his picks was this company called Journey Energy. And basically he came on and said what a basket case it had been. And the stock has been a huge laggard. Basically, he said coming out of COVID, the same management that did really well going into COVID, it seemed like they didn't have the same mojo coming out of it. So the stock was languishing. He had problems with governance. He was really pushing for the company to be in, they have this Duvernay play, but also pushing for the company to be in power generation. And all of those projects were delayed at a time where demand for power generation was kind of increasing. But he stepped in and he said, I think now is the time. And And since then, they have seen success in their Duvernay play. Again, that was a play that wasn't performing very well, but they had this JV with Spartan Delta, which meant that after that, their wells in the Duvernay started to really outperform. We haven't actually seen much of a governance shakeup. Like the CEO is still the CEO. I spoke to Josh, who just had a new baby.
Oh,
so
congrats.
To Josh, a third baby. But he still likes it and he still owns it. He trimmed a little because the stock's up 100%.
Oh, wow.
Since he made that call on our podcast. I really grilled him on it. And I was just like, I didn't see it. He now with the benefit of hindsight. And so it's interesting to learn from those experiences because he was kind of saying like, yes, I know all of this is trash, but it's getting better. And if you listen to my questions, like I'm really kind of going, I'm like, why are you picking this? Why not just sell? It sounds like a total disaster. Good thing you didn't listen to me.
Yeah.
So that name's up 114% since he was on in June. I guess we should talk about Eric Nuttall.
You can't have a commodity conversation without talking about Eric Nuttall, I think.
Eric Nuttall, definitely by far the most popular oil and gas guest that we have on. We will have he's been on twice, so we have the full look at his performance. But I will say this was kind of an incredible year for takeovers in the energy sector. And out of, I think he gave us 5 picks over 2 appearances. 3 of them have been taken out.
Yeah.
New Vista, Meg Energy, and Varen. And he's actually starting to get frustrated, even though he's getting premiums, but he's sort of getting frustrated by these names.
Right, because like sometimes you kind of want to stick with it. I think that's sort of the point, right?
Cole Smead was also on, and both times that he was on, actually, his picks have done pretty well. His appearance for March, he's up about 40%. A lesser known name was Dan Dreyfus, and I know him from Bornite Capital, but he also is a former PM at 3G Capital, which is the big Brazilian fund. And he came on with some interesting, like not household Canadian names, but Cheniere Energy, Ivanhoe Mines, and Talon Energy. Cheniere hasn't done super well. It's down about 5%. He picked these in April. But Talon has doubled. His average performance over those 3 picks is 41%. So not bad, again, like coming on in April. And again, there's going to be a timing issue, right, when we pick these best performers, because the ones who came on earlier with the benefit of time, they'll do well.
Yeah, of course.
But like Lyle Stein, who was just in October, he picked Sprott, First Majestic, and Peyto. And those stocks since October, so just 2 months worth, are up 20% on average. That's like pretty good return for a short period.
Yeah, definitely.
Short period of time.
So one thing we haven't talked about yet is AI.
Isn't that wild?
Yeah. How did we do this whole show without talking about AI yet?
I don't know. Okay, let's talk about it now.
Definitely a major theme throughout, I would say, every one of our shows, because it also hits in the commodity space as well. So it's like, we're never not talking about AI. We're talking about all the stocks, NVIDIA, all the time, it feels like. There's one stock that we've talked about a lot, and that's Alphabet.
I know, not NVIDIA. Okay, so Alphabet is interesting, and it's personally crushing for me. So thank you for bringing it up.
You're welcome.
Okay, so Alphabet, let's recap the story over the past year. Total loser in AI, low valuation, and then they just start to get their rear in gear and outperform. And flowers to the fund managers, because there's a bunch of honorable mentions, like fine, their funds are not up like triple digits, but they're up like between 30 and 50%. So I want to highlight 3 fund managers, Paul Harris, Dan Rohinton, and Mike Vineker. They've all done exceptionally well relative to the market. They've outperformed the market. And the main reason, because each of their picks were Alphabet earlier in the year. So Paul Harris picked it in March. Dan picked it April 1st. Think about how insane that is, because Liberation Day was a couple days later and all his stocks were down like 20% immediately after. They've come back. Dan on that pick is up double on Alphabet since he picked it in April, and Mike Vineker also doubled and has great aggregate performance of 52% over the 3 picks that he has. But Alphabet is the key for all 3. And for me, I've held Alphabet for a very long time, and I was sitting on a very big gain. And I allowed myself to be spooked by one Dan Niles,
And the kids.
And the kids, you're right. It wasn't just Dan's fault, but I was already afraid. But Dan made some like really compelling arguments about how Alphabet at the margins was starting to show cracks. You know, the revenue that they were getting per ad was getting smaller. And I was like, oh my God, it's here. And then, yes, I'm talking to the children, the youth of today who are telling me how much they use ChatGPT. And I just allowed myself to get scared.
Yeah.
And I sold.
You were talking about it like a lot. I remember you were really spooked. The kids really spooked you. And like Dan Niles, then after Dan Niles, you were like, I'm done.
To be clear, I still made money on it because I'd been in it for a long time. But you and I talk about what is our mantra.
Never sell.
Never sell. And that's, you know, roll your eyes, whatever. We're in an age category where we're like, just never sell. My biggest investing mistakes are when I sell too early. See the power of compounding. You know, names like Amazon, which I've owned for a very long time, I'm up like insane, right? Just by letting it ride.
Yeah.
And I know I do like kind of a stock show where we like obsessively talk about stocks. I'm looking at it from an ideas perspective. Like I want ideas. I want to know when's the right time to buy. And I really should remember. Never sell. Like a good company.
There's also another person I want to give a shout out to. And that is our beloved Frances.
Yes, Frances Rodelsky.
Because I remember very vividly in one of our very first episodes that she was on. It wasn't a pro pick, but someone had asked a question about AI and Alphabet, and she said that Alphabet Google was her favorite AI play, and she said that in, I think it was January. And I remember that, and I remembered it all through the Dan Niles youth saga. I actually don't own it, and I didn't buy it, but I just remember that really well. And I would basically trust Frances with my life. So I was like, yeah, okay.
I know, me
Alphabet.
too. I should have listened. I let myself get spooked. But I also want to take a moment and just talk about that, like how we see it show up on our side from a ratings perspective. That Dan Niles episode was the first time we had a viral episode, and he was calling for the markets to go down. He got me out of Alphabet, and his picks were actually Cisco and Microsoft, which have done okay, and holding cash. I mean, that was not the right call. He made that call in May when it was an easy time to be scared out of the markets, I guess. Like we did have that post-Liberation Day rally. But yeah, that episode went so viral, and some of our other, you know, more mundane episodes, just like classic stock picking with value managers. And some of our other episodes, like they didn't do as well from a numbers perspective. I'm just taking the YouTube numbers, but like, so Dan Niles scares everybody out of the markets, 60,000 views. And then Dan Rohinton, right before Liberation Day, says, just stick with the Mag 7. Don't be cute about it. Buy Amazon, Microsoft, and Alphabet, 4,000 on YouTube. You know, we're everywhere. So, but that just gives you kind of perspective on sometimes you can get the better headline story isn't always the best way to make money.
Okay, so we've done our worst performers, but now it's time to talk about the best ones. We had some really great calls on our show this year.
And again, the theme of these is these were not necessarily the most popular episodes. So think about that as we launch into season 3 in the new year. Something you think you're not interested in, you might miss that, like, you know, double or triple in your portfolio, or even like you don't even have that, but like stocks that are just good compounders. So I'm going to start, we have 4 that really had outstanding performance. So I'll go from like lowest to highest and then reveal our best performer. But our first one was Jordan McNamee. Total return since he's been on from March to the beginning of December, up 90%. And that has been largely on the back of Carvana, which is up 86%, and ThreadUp, which is up 218%. He also picked HelloFresh. That's hasn't been good. It's down 34%. But Jordan sort of came on my radar. He was kind of like, he's young. He's an up-and-coming fund manager, now award-winning. He's won a few awards at the Canadian Hedge Fund Awards. That was after he was on our show. He was very early on Carvana. And it was very clear that he's not like just chasing momentum. He owns a small portfolio of concentrated portfolio, I should say, of high conviction ideas. Mm-hmm. likes momentum, not afraid of money losing tech, not afraid of high valuation. And that can kill you sometimes, but this has also been a good market for that. So ThredUp, it basically like gets your clothes for free and then resells them, and then will give you a portion of that and recycle any of the clothes.
When you say get your clothes, you mean like they come to your house and take the clothes you want to donate
I think
somewhere,
you can order, it's called like a free clean out kit.
Okay, yeah.
Right? And then you just send it, you ship it for free, I'm pretty sure. And they'll pay you cash for it.
Right.
And then of course they go and they probably resell it for higher. They're still losing money, but they're losing less money. And their most recent forecast, most recent earnings, they boosted their sales outlook. So they are growing. And I remember when he was talking about this, I was more interested in the service.
Me too. I fully remember that. Yeah, I remember. And now I'm kicking myself for not buying it because I thought the idea was such a brilliant idea.
And it's not available in Canada, unfortunately, but the stock, you could have bought the stock. And that was a big winner. Okay, the second best performer, and this surprised me, a guy named Justice Parmar. He was one of our early episodes, February 25th. He picked Tesla, Rocket Lab, and Uranium Energy. So Rocket Lab, again, it's been a good year for money losing tech. It's been a volatile year, but Rocket Lab is basically a space company. And so Justice Parmar actually invests in these kind of disruptive, innovative technologies. And that whole episode actually was about the space race. And it did not do well. No. Because our audience, like we know, you love commodities, you love dividend paying, and some of it has to do with the demographics. But man, that's a home run. A home run is a home run. And so, flowers to Justice Parmar. And of course, uranium did well because it got caught up in the AI trade. The second one maybe is not a surprise to people because he's been making waves in the investment community for his unorthodox approach, but is Eric Jackson, who was our very first guest on the podcast. And then, of course, came back on when everybody knew about Eric Jackson because of what he was doing with Open Door. But when he first came on the podcast in January, he actually didn't like Open Door. And his three picks were Peloton, BTQ Technologies, and Rigetti, quantum computing. In fact, his whole focus was on quantum computing of that episode. And Rigetti is up 232%, so much volatility.
So much in those quantum stocks.
Yes. But, directionally, it's been higher. So his average gain, Peloton has not been a good call, and I think he cut it loose. It's down 25%. But his total return over those three picks is up 125%. And listen, I'm just saying it could all wash out. This has been a good year for these kind of stocks.
Yeah.
But it was kind of wild. I've known Eric for a while, and then everybody starts to know him.
Yes.
From Open Door. And I'm like, well, I already know this guy.
He was our first guest.
He was our first guest. So we're early. And actually, he kind of links to our number one fund manager, sort of. I'll explain how. But are we ready? Drum roll. They're like, stop doing that. It's messing with the audio.
I'm just going to mention how often I tell guests not to bang on the table.
We're banging on the table. Okay, our number one fund manager, best performance for 2025 was Dan Lewis of Orange Capital. And everyone's going to be like, who is that? Dan Lewis, again, a kind of low, under the radar episode, but he's a distressed investor. So he loves broken stories. And I've known him for a long time in my capacity as a journalist. He ran a fund back in the day, and he was always cropping up in these idiosyncratic, small mid-cap Canadian nuanced stories. And so I got to know him through that. And then he's kind of closed his fund, and now he just manages family money. But he still loves stocks, and he still owns a portfolio of stocks. So I said, come on, let's talk about distressed investing. I talk about dividend and Canadian large caps and commodities all the time. But let's talk about this. And so he comes on, he talks about Hippo Holdings, Claros Mortgage, and Better Home and Finance. And his underlying thesis, he loves these mortgage cos, obviously, and anything to do with housing. And his thesis is that it wasn't really about rate cuts or whatever. He just said, these stories have been overly discounted. I like the management, and I think there is a real business here that is not being fully valued because the market has decided to put a penalty just on the space in general. Hippo's up 22%, Claros up 24%, and of course the home run is Better Home and Finance, which is up nearly 350%. And you and I bought that one.
We did buy that one.
So that was in June.
Well, I'm just going to say what he said about that one. He said that, there is a chance it could lose all its money and go bankrupt, but there's a better chance it could become the next Carvana.
And so we were like, cool, we're going to take that bet. And it worked out. And then come September, after Eric Jackson been kind of pounding the table on Open Door, he came on the podcast in September as well, and his returns aren't as good as they were in January, but it's only been a few months. But his second idea, Jackson's second idea, is Better Home.
Yeah.
And me and you are like, terrific. We already own that.
Yeah.
And then it turns out that Eric and Dan had spoken about this idea, and Eric had watched the podcast.
Yeah.
So that, again, there's these like little moments where you feel like, oh, wow, this community, this platform that we're creating, I'm not in my basement. I know a lot of people are like, is she recording from home? Like, we're a real place.
Yeah.
And we get these like really high caliber people who are, making decisions, from the CEOs, from the kind of investors who listen to us as well, and from the fund managers who come on.
Yeah, I think we've had that from a few people. A few of the fund managers we've had on have told us that they've gotten ideas from other fund managers. And to me, like, that's a real sign of success for us. So
we're going to pat her. No one's giving us flowers. So we're going to give ourselves the flowers. Okay, so here's what we did. We caught up with Dan Lewis. We asked him, do you still own Better? And what's your next big idea? And guys, he told us, and it's coming up right after the break. If you're a do-it-yourself investor looking to take control of your portfolio, BMO ETFs makes it easy. Whether you're exploring stock replacement strategies or you want to find ETFs that hold your favorite companies, their tools are built to help you invest smarter. Check out the ETF Compare tool, the Stock Replacement tool, and news and insights under the Tools section at bmoetfs.com. It's perfect for analyzing your options, spotting trends, and building a portfolio that fits your goals and timeline. Dan Lewis returning to the podcast, triumphant. Thank you so much for rejoining us.
Nice to be back with you, Amber. Thanks.
So you are, we've just invented this title, but our best performing stock picker of 2025 through your pro picks of Claros Mortgage, Hippo Holdings, and Better Home and Finance, which was honestly the true home run. That one was up 300%. And I just want to remind people of your style of investing, because you came on and you're not maybe the traditional large cap, Canada, US, dividend seeking fund manager. You have a little bit of a riskier profile.
I think certainly in the stock picking, I've been in the distress business and the special situation investing business for almost 30 years. And I still, of all things, love to be an analyst first. And so it's not work to me to be looking at some of these companies.
So Better Home, let's spend a beat on that, because probably a name a lot of people weren't familiar with. I certainly wasn't before I bought it, after you came on the show. So thank you for that, because it's been nice for my portfolio. But basically, a digital mortgage company uses AI to really quickly, approve those loans in the US, but also has started to white label that platform so that other banks can use that technology. Did the investment go as expected?
Better went as well as one could have hoped. And the reason why I think the price, beyond some of the noise, reflects some fundamental changes is that they've announced already a number of deals with financial platforms, one of the largest, over 50 million customers, large distributors of mortgages who are going to be using Better, which means that they will be originating through their own customer base, but using Better's immediate instant approval AI-based solution for the entirety of the mortgage chain, all the way through to selling the loan into the capital markets. And so for them, it's an unlock where they used to have to go on as a direct-to-consumer company, advertise on something like a NerdWallet or a Credit Karma, and compete with everybody else. Now they're actually getting customers funneled by these platforms, which it totally changes the game for them. So very important, large players in the mortgage space are adopting Better. That's their strategy, is to go after the big fish and give those folks a competitive advantage because of the AI-based solution. And so the opportunity for the company is as big as ever. And they've said that they're going to be more than doubling their revenue run rate by the end of March the next year.
And like this was a stock that kind of got crushed coming out of the pandemic. And to your point, what it is now is not even what it was before the pandemic, right? So
that's right.
You said it was like the AI play that everybody is looking for because of how it uses that technology. And that was in June. And then in September, it became sort of a meme stock all of a sudden. One of our guests, Eric Jackson, hot off of his open door streak, said, Better is the next one. What did you make of that?
Well, I think that I agree with Eric in the sense that Better certainly is a company that's changed so fundamentally from when it first became public or was a VC darling. They went from a direct-to-consumer mortgage player to an actual platform as a service, charging customers, banks, platforms on a fee per loan basis. So it's a totally different company, and they have enormous amounts of experience in already originating these loans. So AI is the foundational layer of solving a really important problem. And so I would agree with Eric on his enthusiasm about the stock. But I think the most important thing was the actual news that came out of the company starting at the end of September and into Q3 earnings.
Now, the stock, it's had a big run up from June when you picked it, but it's down about 40% from October. And I wonder if part of that has to do with the fact that it did become quite a retail darling and a meme stock because, as you said, like the results were good.
I think that the retail component adds volatility to a stock that's already volatile to begin with because the market doesn't cover enough of Better, and Better hasn't proven out the concept yet. Are they really the AI platform of choice changing the mortgage industry, or is this really just a meme stock being promoted on the internet? And so as the market starts to determine whether it's real or not, it's going to add volatility. And so it's up to the company to execute. If they execute on what they've said they can do, the stock will be fine. And certainly, I would note that I filed a greater than 5% ownership of the stock in October. So
after the sell-off, so your conviction is still there.
Correct.
So that was a home run. Now we want to know what else you got, right? What have you done for us lately? So you've actually brought not one, but two names to talk about. The first one is Accelerant. Not a household name, but a stock that went public this year and has been under pressure. It's trading below its IPO price. What is Accelerant? Why is it down?
Accelerant fits the special situation construct in that it is a IPO that went badly. And I think it went badly for a couple of reasons. Let's start with what Accelerant is and what it's not. Accelerant is what's called a risk exchange. It's a little bit of a new terminology in insurance, but they bring together specialty underwriters, very unique types of insurance, mostly in the small, medium-sized business space. Some of those underwriting teams they own, some of them are third parties, and they match them with private capital, which is capital that they raise, or insurance capital or reinsurance capital. And so they're really in between solving a problem in the overall value chain. They sold the IPO to the market to tech analysts, to tech PMs. And they had this vision that they are a giant data lake and able to underwrite magically better than anybody else. And after the stock popped to over $30 when it went public, people realized it wasn't that at all. In fact, then the analysts started to perseverate on a number of issues. First of all was, who is the actual carrier of record in the Accelerant chain, which to me is the least interesting or important part of the equation. That's something that I talked about with Hippo last time I was on the call. But the stock was under pressure. It traded down to as low as $12, $13 a share. And at the same time, it's one of the fastest growing players in the specialty insurance market, has a wonderful flywheel of attracting more underwriters, which attracts more capital. And it's a largely fee-based business where they do not retain significant amount of risk on their balance sheet. I think it's about 6%.
So I did some, to try and understand what this business is. It's basically matchmaking, right? If you're just this niche underwriter who needs to underwrite like 500 trucks or something in the Midwest, right? Instead of you as an individual or as that underwriting entity trying to find somebody to take that on, you plug into the platform. Is that right? And then on the other end of the platform are a bunch of these insurers that are looking for those kind of opportunities.
Looking for that risk as part of an overall risk portfolio. And those could be private investors, people like me who are looking for undiversified types of risk and deploying that capital, or it could be insurance companies looking to diversify. So if you think about maybe someone specializes in coastal flooding in the Southeast United States, they can come to Accelerant. Accelerant can underwrite that business. They can own that underwriting team and earn more commissions, or simply just play in the middle, earning a fee. And then they find paper and insurance carrier to actually write the insurance. You need somebody to do that. And then match that with ultimately the capital and reinsurance on the back end. So it's a really interesting way to think about taking advantage of a broader trend in insurance more broadly, which is specialized teams of insurance underwriters don't want to work at AIG. They do these insurtech startups. They start up their own unique types of businesses, but they need a carrier to write paper on, and they need capital to put it behind it. Accelerant fits that trend. It was trading down as low as, single digit, EV to EBITDA multiples, which is a good metric for these types of business, which implies really shrinking or X growth when in fact the business is growing 25, 30% a year. And so to me, I think if you really do the work on the business and you see it at this price and they're able to execute even on baseline guidance, will be up 50%, and it can compound with growth over time, and to say that stock could certainly be back in the 30s over time.
And so the name of the game is just volume, right? The more deals they do, the more that are on the platform, the more transactions they facilitate, that's just all gravy to them. And that's how you see this playing out?
That's right. And the people that were worried about the stock was because Accelerant was using an insurance carrier in the middle called Hadron, which is affiliated with their private equity sponsor, where that was the entity where the insurance was actually written, the carrier itself. But that entity doesn't even carry the risk. That goes to the reinsurance market anyway. And so I think because it wasn't an understood IPO, people really perseverated on this issue, and it is absolutely a nothing burger. And I think the company's trying to start explaining why that's the case.
So the names that you brought us so far, whether it's better, they play in this kind of mortgage, insurtech. But this other idea that you're bringing to us is Wix.com. It's almost like a throwback. It's a website builder, but it's down. It's down bad, as Taylor Swift would say, down 50% this year. What is ailing Wix.com at a time where it's trying to say, hey, I'm over here, I'm in an AI story too?
So I think this year has been pretty instructive in that we started with Google being dead. And we're emerging at the end of the year is that Google is actually the likely winner, or at least one of the winners. And I think the same thought process we need to put into software solutions, which is this idea that AI is this Pac-Man and these companies are all going away. Your web hosting and your website construction, the how you actually are able to be found on the internet is more important than ever, because that's what these LLMs are crawling all over. And so it's not like you don't need this type of solution. And so I just think it's funny that people would say there's a massive obsolescence risk when in fact e-commerce is more important than ever in how you set up your business online. The other part of the equation, which I find interesting, is vibe coding. And people think that suddenly because you can get online and start to build something either as a developer or a zero tech founder and build a prototype means that somehow you don't need engineers and coding and real enterprise software. That is absolutely not the case. You can get an MVP product, you can get something to go to market, but it's not a scalable solution. So I think as technical debt starts to pile up on these vibe coded solutions, people are going to realize there's a reason why some of these important vertical software companies exist, some of these horizontal companies exist. Wix falls into that.
Vibe coding is basically like I just described, hey, I want a website that does this, has this feature, and so I don't have to be a programmer. And then the feature just magically happens, not magically, but through AI. And so was the concern that that'd be disruptive to Wix and like some of the things that it has?
You wouldn't need that service anymore. And so what Wix actually did over the summer, which makes the stock even more interesting, or call it hedged, is they bought a vibe coding startup called Base 44. And base 44 has gone from minimal ARR of a couple $1 million, I think it was a $3 million, to $50 million at the end of Q3, and with a line of sight per the company of $100 million. They are one of the fastest growing and taking massive share in the vibe coding space as part of the Wix ecosystem. And I think it proves the point, which is building software is not the barrier to entry per se. Having the distribution for your software is as important as ever. And so Wix, by buying this vibe coder, is now able to distribute this to its customer base and is now taking share and competing directly with Lovable and Cursor. And it's certainly one of the top 5 in the marketplace.
You know, I did some digging into this. I mean, it's not like it's a high multiple name, at least not anymore, right? It's trading at 15 times the earnings. Its growth forecast looks like they are moving higher. They're not as high as 2021, but since then they've been increasing. The complaint I see is around like something like margins, right? So all of this AI spend, it's expensive. And so are they being penalized just for spending on these initiatives?
Well, this is, I think, why the story caught my eye is you can check online. There's a transcript you can read or listen to at the UBS conference. In November, the company reported earnings and they reduced their guidance for gross margin, operating margin, and which led to a round of street cuts in estimates. And the stock was down 20% on earnings. I love why the stock was down 20% on earnings, which is why I felt this was the right time to start thinking about the trade. The company has been very clear that core Wix margins are actually rising and benefiting from AI productivity. The reason why the margins were declining was because they're investing in marketing associated with base 44, and the compute costs that come with that, both of which they say will normalize and decline over time. But if you're telling me that to accelerate the growth rate, which obviously is going to massively improve the multiple, they need to take a short-term hit to operating margin, it's a fantastic reason to cut estimates. But when you have a stock that's very owned by hedge funds, that's very sensitive to a value-based community, and people with a lot of AI expectations around base 44, no one wants to walk into their PM as someone who's been in this industry a while and say, hey, I know that the EPS cuts are coming in minus 10%, but we should buy the stock. I think when they get through this, they have an AI story. They have a proof that their customer base needs them more than ever. And the stock is trading like it's going away.
All right. I love that. So Accelerant and Wix.com. Before I let you go, I would just love, because you're one of our more unusual guests in terms of, you obviously used to have a hedge fund. You're still investing, through the family office, but just how do you think about, your own platform, your own voice? I know that you do a lot of mentorship and you're really interested in early stage stuff. How does all of this fit into that?
I think one of the interesting parts of my journey now is as some other ideas are rolling off, and what am I going to do next in a career path? And I embrace the fact that my career is not a traditional one, and I've loved the opportunity to manage money for others. I love investing more than ever. I think it's great to have a lot of years behind you where you can frame, market situations, companies with so much points of reference, right? So what that means for me in terms of how I want to deploy it is an open question that I've been thinking about.
All right. Well, that sounds like a stay tuned. We'll hear more from Dan Lewis. Thank you so much for joining us. Happy holidays.
Hopefully I can win this again next year, Amber.
There we go.
See ya. Thank you.
Okay. Now that we have our hats, we're going to toast again. So we're going to do it again next year, but we're not going to leave people hanging. We've got an incredible special, a holiday special hosted by Paige Ellis. Many people will remember she was my coworker at BNN Bloomberg. Love Paige. She is doing a special on alternative investing. I love stocks, I know, but there's a whole other universe out there. So we're going to talk about what's happening in private investments. We're going to give you like a primer on private investments, what you need to know, how you evaluate them. We're going to do a special focus on real estate. That's our second episode. And then our third one, probably the people to do it best in Canada, Brookfield. So Sachin Shah of Brookfield joins Paige for an exclusive 1-hour interview. You won't want to miss that. And then when do we come back? I guess I should know.
We're coming back December 13th.
No. Wrong. Do I need to do this? What's in your mimosa?
Sorry, January 13th, 2026.
Our first show back is January 13th, 2026. We will have a hot and fresh lineup for you, which we'll reveal later. And I think we'll probably start the year with some swag.
Yeah, definitely got to do a new swag giveaway for sure.
Not these hats, though.
We could. Anyone want it?
In the Money Santa hats. Cheers, Jillian.
Cheers.
It has been an absolute privilege to work with you this year, and thank you for building with me.
Been a pleasure. Thanks, Amber.
And to Georgine and Million, thank you so much.
Cheers to you guys.
They're cheersing.
They're cheersing.
See you next year.